Hey guys, Ken Boyd with the Accounting Accidentally website. This is the first video that introduces the revenue recognition discussion of 2020. And at the bottom, you'll see a great resource that is a link to PwC's website on the topic. They've got a great resource that I'll use to explain it. Remember, in Accounting Accidentally, you can find over 350 blog posts on accounting and links to almost 400 of my YouTube videos on accounting. So why does revenue recognition matter? Well, timing is everything when you recognize revenue as a direct impact on your net income. And one big principle in accounting is the principle of consistency, the idea that we need to use the same accounting standards and policies consistently so that the financial results are comparable between months, between years. So let's think about an example. A furniture manufacturer whose policy it is to recognize revenue when goods are shipped. So when the goods go out the door, that's when we post revenue to the income statement. In the last week of the year, however, there's a company needs a $10,000 increase in sales to get the company above break even for the year. And that's a big deal because the firm's going to give financial statements to potential investors to try to raise capital. So making a profit is really important. So on December 28th, the company posts $12,000 in revenue when goods are invoiced. They have not been shipped yet. And that's the problem. So what's the impact of changing the revenue recognition policy? Well, by posting $12,000 more in revenue before year end, you are inflating sales in the current year and you are artificially lowering revenue in the next period. So in essence, you're starting January $12,000 in the hole or in the negative when it comes to revenue. It's an inconsistent policy. You violated the revenue recognition policy. Normally, these policies are stated in the footnotes of the financial statements. You violated that policy, and the problem is shareholders can't compare financial statements by month or by year with confidence. If you violate the policy, how do you know if it's, quote, really revenue or not if you're changing the rules on when you recognize revenue? And the bigger problem is the risk of more manipulation down the road. What if the firm violates the policy in January and February or year end 2021? Will they post a $100,000 change rather than just $12,000? The problem can snowball. So the website that you see on the screen ties to the link that you saw on the first screen that I showed. So when you click on that PwC link, you're going to see this revenue recognition page. This is what I'm going to use to explain the material. It's excellent. If you want to go to the FASB itself, here's the address, and you'll see that it's revenue from contracts with customers. The topic is 606. This is frequently tested on the CPA exam. Also important if you're going to work in accounting. Remember that you can go to conferenceroom.mn.co if you want to join for free, set up a profile, participate in live chats, videos, articles, blog posts. We all post it here in Conference Room, which I think is a more interactive way to learn accounting. Thanks very much, and we'll see you next time.